PhillipCapital's Expert Talk. My name is Lindsay from Phillip Securities Research. Today we are privileged to have Dr. Bill Maldonado, Chief Investment Officer, Asia Pacific, and Strategy Chief Investment Officer for Equities Globally from HSBC Global Asset Management, to share with us some of his insights on Asian markets amidst these uncertain economic conditions. Based in Hong Kong, Dr. Maldonado oversees the investment strategies in the region. He has worked in the asset management industry since joining HSBC in 1993 as a European derivative-based portfolio manager. Over the past 20 years, Dr. Maldonado has headed up a number of investment functions, such as non-traditional investments, including passive indexation mandates, fund of funds, structured products, and hedge funds. He became Strategy CIO, Equities and CIO for the UK in 2010. He was also involved in the management of some ASEAN portfolios in Hong Kong during 1993 to 94. Dr. Maldonado holds a PhD in laser physics from Oxford University and an MBA from the Cranfield School of Management. Thank you, Dr. Maldonado, for taking time to attend this interview with us. Let's start with the ASEAN markets outlooks, shall we? While the US is preparing for interest rate normalization, the rest of the world is embarking on easy monetary policy. How will these dynamics impact the Asian economy?
Yeah, it's a good question. I think we're seeing a divergence in policy for the first time in a long time. I don't think, though, that the divergence is going to be as great as we might imagine. So, for example, the Fed is going to be withdrawing liquidity from the system relatively slowly. So liquidity is going to stay flat in the United States, more or less, for the next couple of years, more than likely. And then on top of that, the Japanese central bank, the BOJ, and the European Central Bank are going to be adding liquidity. So I think the liquidity picture is going to remain very supportive for risk assets. So although you're right, there's a divergence for the first time in a while, it's not going to be as exaggerated as we feel maybe at the moment.
Could you share with us how the stronger dollar impact your investment strategy?
Well, again, I think there's been a bit too much concern about a strong dollar for Asia. The normal negative transmission mechanism for a strong dollar is via energy costs, the oil price, gas, other commodities as well. And actually what we've seen is a very big decline in those prices, either in US dollars or in any other currency. So one of the main transmission mechanisms is not really there to hurt us. On the other hand, a strong dollar is positive for the US consumer. They'll be able to consume a lot more goods, a lot more services, a lot more of the stuff that we manufacture and add value to in Asia. So actually it may not be such a big negative in the end. It may actually be a positive.
Following that, any particular country, industry, or sector that you are optimistic on?
We're trying not to take a currency view of the world, simply because it's very, very hard to forecast currency moves. You know, I have colleagues, there are people out in the market who spend their entire lives trying to forecast currency moves, and even they are not always successful. So it's a very, very difficult thing. So what we'd rather do is work the other way around and say we like a company, we like a stock, we like it because it's cheap and it's very profitable, and then we worry about currency as a potential risk, and we try to evaluate how much of a risk it might be. And that's the way around we like to work. And on that basis, there are lots of opportunities where we don't really see the strong dollar being any kind of a barrier to the really good fundamental story that's there on profitability and valuation.
Notwithstanding the diverging monetary policies, we also see slower global growth, disinflationary pressure, geopolitical risks, and renewed boost on euro crisis. Are there any other risks that investors should be cautious of?
Look, I think one of the main risks that's out there is geopolitical risk. it's very difficult to forecast, very difficult to do anything about that. Even if you can correctly analyze the risk and the evolution of a conflict or a geopolitical issue, it's very difficult to then draw correct investment conclusions from that. So that's very tough. So I think that's one main set of risks that are out there, but there's not much investors can do about that, unfortunately. The other big risk that's out there is that there's a policy misstep by a central bank, especially the Fed at this point, that they raise rates too aggressively, or that they remain on hold for an extended period of time and that inflation runs away. So we as investors are walking a fine line. We're in a very fragile equilibrium between rates going up too fast and rates not going up fast enough. So we're in an equilibrium between growth being too strong and deflation, effectively. And it's a tightrope for investors and the central banks to tread. But we think they'll do it. We think there'll not be a policy misstep. We don't think they're going to push the economy into recession, and we don't think that there's going to be runaway inflation either. But that's still a risk. There is a risk that the central bank could misstep, and investors should be aware of that.
Referring to what you have mentioned just now, how should investors position themselves amid this high risk environment?
I think that one of the things investors need to be clear about with themselves is that medium to long-term returns from all asset classes are going to be very subdued. So they've seen very strong returns from equities over the past couple of years. They can't expect to see the same levels of returns for the next 5 or 10 years. We expect returns to be much more muted. So I think a long run expectation will be an average return of around 9 or 10% notional, so 6% real, something like that. With that kind of expectation in mind, then I think that equities are still the best place to be, or better, to put that a better way, I think, investors need to have exposure to equity markets, because the expected returns from risk-free assets, from government bonds in particular, are going to be really low, close to zero. So equities, credit, high yield, they're the few places that investors can expect to make positive real return. So it might not be very comfortable, it might not even be very exciting, but in a way investors don't have much of a choice but to be there.
Moving on to Asia's largest economy, China. China remains under pressure as it tackles mounting challenges in the slowing economy, such as deflation, overcapacity, and property slump. Do you see a market correction looming with the Shanghai Composite Index year-to-date return ended in red after a more than 50% rally in the past 1 year?
Look, I think it's very difficult to forecast short-term market moves. I'd say it's impossible. So you're giving me a question that's impossible to answer, really. But what I would say is this, that in terms of trying to make some estimates about what might happen, not over very short time horizons, but over the next 12 months, maybe even out a bit longer, Chinese equities are still very cheap. They're still the cheapest equity market in the region, and it's a very profitable equity market. And within the market, financials, cyclicals, property, a lot of things that might be impacted by the factors that you mentioned, which have been weighing on investors' minds, they're incredibly cheap and very profitable. So I would say yes, there could be corrections anytime. That was a very big rally that happened very suddenly, very sharp rally, very unusual for a correction like that to happen upward. We're more used to seeing corrections of that magnitude and speed happening downward, so it was like a big upward correction. But the fundamentals, even after that move, the fundamentals are still very supportive. So as long as you don't believe that there's going to be a hard landing in China, and we don't believe there's going to be a hard landing in China, as long as you believe that the authorities in China are going to keep the economy on track, that they'll stimulate in a targeted way as necessary, which is exactly what they're doing, then we think that Chinese equities look really, really interesting still.
On the other hand, after the hype of Shanghai-Hong Kong Stock Connect, the premium of mainland shares to their Hong Kong listed counterparts has widened to about 20% today, according to the Hang Seng China Premium Index. Would you consider the Hong Kong shares to be more attractive as the A shares are relatively more expensive and the yuan is depreciating while the Hong Kong dollar is set to strengthen because of its link to the USD?
Yes, so on average for the dual listed shares, but there's a very big divergence either side of that, both on the H share side, on the A share side. So the average premium is, as you say, around 15 to 20%, but there are some A share companies that are trading on much higher premiums and some A share companies that are trading at a discount to H shares, and of course vice versa. It works, you can look at it the other way around as well. So we would say that the Shanghai Hong Kong Stock Connect has been a big success. We've taken advantage of it. We've found some great opportunities there. I think it's a great facility for institutional and retail investors to take advantage of. And there's still a lot of interesting stuff to play for there. And the premiums will shift around all the time. We've been both sides of the line, if you like, and always there's some companies which are cheaper, some companies that are more expensive, so there's always some situations to look at.
Chinese authorities had been refraining from taking aggressive measures, in particular cutting interest rate, as the move would re-inflate asset bubbles, backtracking their effort in clamping down on credit and reining in speculative purchases that have fueled unsustainable growth in home prices. So, can you also share with us your view on the latest move by PBOC? Would it actually jeopardize government's reform or even possibly cause a financial instability?
No, I think that actually the other way around. So the first thing to say is that the amount of room that the Chinese authorities have to maneuver is huge compared to, say, Europe or Japan or even the US. Real rates are relatively high in China. The reserve ratio requirement is amongst the highest in the world, if not the highest in the world. So they have a huge amount of room to maneuver, and they've been very cautious about putting stimulus into the economy. They've really tried to be very disciplined about it. They've done it in a very targeted way where possible. The RRR cut was very small. The RRR is still huge. Interest rates, we've seen some cuts last year, could come down a bit further. So basically, there's a lot of weapons in the armory if they need them, compared to most other big economies. So we actually have a lot more confidence in the stability in a country like China, where there's a lot more tools that can be deployed, where we'd be more concerned where central banks have run out of tools and they're having to use extraordinary measures like quantitative easing, etc. That's a much riskier proposition than conventional tools.
Like what you have mentioned, the Chinese government had been deploying various liquidity tools. However, these targeted measures had minimal impact on the economy.
Well, so don't forget, those tools are not aimed at driving the stock market. They're aimed at maintaining stability and growth in the economy, and that's worked. Growth has been around 7%, which is where they wanted it to be. They believe that that's, for now, the level they'd like to see the economy growing at. There's not a very strong connection between GDP growth and price movements in the stock market, not just in China but in any economy in the world, those kinds of connections tend to play out over much longer time periods. And in China, indeed, you've seen very strong growth in GDP over a long period of time, and the stock market hasn't really followed. So, you know, there's a whole set of reasons for that. But actually, right now, the equity market looks very attractive, and we do expect some kind of feed through from good management of the economy.
India seems to be one of the few Asian or even global bright spots. When the ASEAN countries are struggling with stronger USD, high levels of debt, and lingering political risk, in particular to Indonesia and as well as Thailand. The Indian equity has rallied more than 40% in the past 1 year. Do you think that there are still upside to the market?
Yeah, it's a good question. So we are still very positive on India, but we can't say that it's cheap. Actually, it looks expensive today. For its level of profitability, there are probably better opportunities today. So to invest in India, you really have to believe that it's going through a transformation, restructuring. I think the central bank governor, Rajan, has done a fantastic job of stabilizing the currency, the current account deficit, and general kind of management of the economy, that monetary management of the economy that the central bank is responsible for has been excellent. And now the government has been doing its bit as well, and they're also greatly helped by falling oil price. India is a big importer of oil. So, for example, they've managed to remove subsidies on diesel and kerosene and gas, and yet consumers have seen falling prices, even though they've removed the subsidies. So all of this is very positive for India, and we do believe that it's going through a transformation under the Modi government. But that's going to take a long time to play out. If we're right, if we and other investors are right, what that'll mean is that GDP will be structurally higher in India, and there'll be an even better environment for Indian companies to operate in, and the consumer will be an even stronger force in India, and hopefully there'll be more of a manufacturing sector as well. But that's not going to happen overnight. That's a long-term play. So India's not such a easy story as China, for example. China's cheap today and very profitable today. India's not cheap, so you'll have to believe in the restructuring.
Like what you have mentioned earlier, that the equity market doesn't really correspond to the economic growth, which brings us to this scenario in the ASEAN economies, where despite the risks and weaknesses, the equity markets are actually still on upward trend. In your view, what are the possible catalysts or factors supporting this upward trajectory?
Equity markets over the last 2 years have come off very low valuation levels. We were trading sort of one standard deviation cheap relative to long-term valuations 2 years ago. It's rare to see markets any cheaper than that other than during crisis periods. So markets really were very cheap. They've come off those lows, and they're mainly now looking close to fair value. Maybe Asia's looking a bit cheaper, US looking a little bit more expensive, Europe around neutral, but we're all pretty close to neutral. So the next move up in equity markets really can't come from multiple expansion or from just rising PE ratios. It has to come from an improvement in earnings. We have to see earnings turn because they've been declining over the past few years. We have to see them stabilize and go up. In Asia, I would argue that's happening. I mean, you might think I'm being a bit of an optimist. You might be right, but we think it's happening. In Europe, we're still not quite there, but it could happen this year. In the US, I think it's happening. So that will sustain the next move up in the equity markets, rising earnings, improving profitability.
Once again, thank you, Dr. Maldonado, for sharing your insights with us here today. For more information on unit trust, please log on to www.poems.com.sg/unittrust or talk to us at any Phillip Securities branches. Thank you.